Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Econ Show, we're only going to do 5 segments. I know everybody enjoyed the extra segment, but we're going to cut it back a bit just because we've covered a lot. Try to focus it a bit more on some specific topics. So in the first segment, we're going to look at global growth, but also we're going to look at it in the lens of, well, what is happening with commodities? Because commodities continue to surge. We continue to see an increase. And is that going to become a detriment to that growth profile that a lot of people are expecting? Next, we're going to go into U.S. wages and look at what is happening with wages, what is happening with inflation in terms of wages, and how far is your money going? I know we keep talking about that, but we want to hone it in a bit more and think on it critically when we think about U.S. confidence, and then what are we seeing from companies' job postings as well. Then we're going to go into company pricing, and we got a lot of the Fed data dumps in terms of what is happening with pricing. That's input prices, what is happening to prices received, prices paid, delivery times. This is where we continue to see that inflation through the system, and it's just now really starting to push through. Then we're going to do Europe and go through all the different countries, but more specifically, Germany starting to slow a bit, while the rest of Europe is starting to improve. So we want to look at, what is, and by, Germany slowing, it's not considerable, but there is a certain amount of slowdown while the rest of Europe is getting a bit better. And then we're going to turn to Asia and look at, a few weeks ago, we made the call that Chinese exports, not that they were going to go down, but they were going to become a bit stagnant, and other countries within Asia were going to make up the difference. And we're starting to see that come through. And something we've been saying for the last, 2-3 months, that credit impulses were rolling over in China, and it's really starting to hit home now. So we're going to look at that in more depth. So just to kind of give you an idea, if you have any questions, please, reach out. Always enjoy the back and forth. But the one spot that we want to start with is China's agriculture imports, because here you can see just the inherent surge that we're seeing across the board. And it's in corn. We're actually starting to see wheat increase because corn prices have gone up so much, and they're trying to now substitute some of that with wheat. They're trying to adjust the way what they feed their livestock to preserve more for human consumption. And as we said in the EIA show, China's already buying next year's U.S.'s corn crop. So we're talking about a significant move up. And the problem is we're not only seeing demand increases, we're seeing supply issues. So this is not just like, oh, don't worry, I can turn on the manufacturing machine faster. Biology doesn't dictate that. Biology dictates that. We can't make corn grow faster. We can't make wheat grow faster. We can't make it happen. And that's why we can do things to protect yield, be more resilient, but it takes time. Yeah, you need an emergence, you need a root system, you need to feed it, water it, love it, take care of it, talk to it. I don't know, do whatever you need to do to move these in the right direction. We've come to a near perfection when we're talking about how to treat the soil, what fertilizers will go with which. If you're bored, I'm happy to go through the different percentages of potash, phosphate, nitrogen for different ones. I do find it interesting, but again, these are the issues that we're going to continue to see. And food inflation is the biggest problem in the world right now. We can talk about energy inflation. We can talk about inflation in other commodities in the general market, but food inflation is so important because this is how you survive. This is what you're going to put on your table for your family, and this is for most of the world is over 80% of their paychecks. So when you have these numbers accelerating the way they are, you're taking money that would go to other things being focused directly on food, and some people can't even afford it now. This is what, again, if your health or if your survival comes into question, that is when wars happen. That is when unrest happens, which is why we talk so much about grain prices, food prices in general. And now when we look at the U.S. weekly inspections, here you can see just in terms of where things sit on the corn side, soybeans, wheat, there is continuing to be movements. We're essentially right in line with where kind of we should be at this point in time. The inspections were better for corn. But again, we're continuing to see just a lot of premium get pushed in because we're continuing to see these movements. Now, this is just looking at grains. I've shown the UN charts, all the others. But now let's move over into the other commodity worlds, because when we look at steel, now we're going to talk about steel for a minute, because the China just they reduced rebates on exported steel, and they decreased VAT taxes on imports. And the whole concept was to try to disincentivize exports and incentivize more imports. And this is why you're seeing that happen, is because we continue to see steel prices going into multi-year highs in all major markets. Now, there's a mixture to that. There is a lot of demand. Everybody's talking about infrastructure. Everyone's talking about these movements where, we have massive delays across cars, across, consumer goods, or supply chains that have been whittled through. So clearly we need steel, and it's being priced to at an elevated level. But you're also seeing iron ore, coal prices go up. So this is going to be an amalgamation of that within a percentage. So clearly they're going to continue to go up. So export prices remain, for China remain at depressed, but now you're going to start to see some of that come out of the market, which will be good for some of the pricing in the U.S. But with that being said, Chinese steel margins have recovered, because remember the last time we talked about it, they were in this negative level, had that nice little spike, but then really cooled off. And we were assuming that you were going to see, obviously, another spike higher just based on where PMI went, where some of the industrial production went. But then when we looked at credit impulses, which we're going to talk about in more detail in segment 5, we thought there was going to be a bit of a rollover. Clearly, there has been no rollover. It's just been straight up and out. And you can see going back to 2019, all-time highs, which is happening even though they have an elevated amount of storage, of inventory, which just speaks to kind of how they're trying to, the mixture of the export market, import market. You're just starting to see some of those benefits in general, where you're just seeing more money being made, which is why when we look at the Chinese rebar inventory, when we look at copper, rebar within China still remains well above the 5-year average, still almost tracking where it was in 2020, but yet we're seeing a lot of pricing. So you can say the same thing with lumber. When you look at trees, we have more than enough trees. Like there is not a shortage of trees. There is a shortage of sawmills, which is creating this lumber shortage because we underestimated lumber demand. So we shut down way more sawmills than we probably should have. We were late to getting them back. And then obviously COVID resurgence limits the amount they can operate. So this is keeping this. And then obviously you can look at the housing market, all of those levels, and that's keeping that bid beneath lumber. So here we've seen some of these facilities come offline for different reasons, which is one of the reasons why we continue to see kind of this pressure. And when we talk about what comes next, it's always going to be, where is pricing? How does this normalize? And that's where we continue to see some of these pressure points as the Fed data now comes out. And Fed says inflation has risen, largely reflecting transitory factors. We will go through a great lengths today to show how they are not transitory. But when we talk about some of these issues, now we look at that growth level. So let's look at some of the leading indicators done by the OECD to look at, okay, well, who's growing, who's weakening? So the OECD area, on average, has seen some stable growth in terms of 2021. You had some slowdowns in January with the resurgence, but now you're continuing to see these moves higher. And we still see that. We're not like, there's never a point where we're saying that there is no growth. We're saying that there's going to be pressure to what that growth is and how fast we see that growth. Because the Euro area, continues to be under pressure, starting to see some of that wake up a bit in general. But now when we start looking at Canada's going to be come down based on the new lockdowns. France is getting better. Germany is flatlining. That's going to roll a bit. But the U.S. is the one that continues to see that steady increase. And it's that's why the OECD area is stable growth, and some of that is the mix. We have stable growth, we have steady increase. Some of the steady increases are starting to tail a bit, and that's going to see some of that slowdown because the last month growth cycle, you're seeing some of that continued slowdown. And when we look at Brazil, when we look at China, India, and some of the key emerging markets, and with Russia, you're seeing some of that slowdowns as well. Not that they're not growing, because it's just the growth is slowing. And the question is going to be, how bad is India based on COVID? And that's going to put additional weight on what that looks like, because when we talk about stable growth, steady increases, China's starting to roll over a bit. Again, not collapsing. It's just flatlining for the most part. Euro area will continue to close that gap. The U.S. is seeing that steady increase, which again is starting to flatline a bit with the different tailwinds, and because there's a mixture of tailwinds, headwinds in terms of what is happening in the market in general. But overall, we're seeing that steady growth. Now, when we talk about the recovery in Asia, it's important because that's where we see the biggest significant slowdowns coming up. Because when we talk about the advanced economies versus the emerging market economies, so advanced economies, obviously the U.S. is going to continue to be strong. It's going to support some of these different areas. And when we look at Japan, Korea, Taiwan, those three areas, we continue to see a recovery in retail sales and strong exports. Now, Japan is starting to see COVID cases. The emergency lockdowns are starting tomorrow. That's going to start to eat into some of that growth, but Korea and Taiwan continue to see some of that movement. Now, when we shift to emerging markets, that's where we start to see some of that pressure. As we said from day one, that India expectation for 2021 is far too high. And it was because of where their end markets were going, who was buying it, and just in the matter of we expected an increase in COVID. To this level, no, but yes, we did expect that increase in COVID, which is going to depress some of those numbers in terms of that 4.3%. That 12.5%, where China at 8.4%, they have talked about 6%, targeting 6%. Based on the data we've seen, the slowdown in liquidity, the slowdown in debt, the slowdown, there's a lot of slow in what I just said that is going to pull back on some of that growth projections, which again is going to be a bigger issue in terms of the growth profile. Now, Vietnam is the one that we think is going to remain fairly strong. They had their first case of the Indian strain. Let's hope they can keep that under control, but they have flagged that as a potential problem. Net, the Asian markets I think are going to disappoint to the downside based on what we're seeing on the just global growth level. The exports have been strong, but the residual market isn't reflecting that, or the shipping market isn't reflecting that on a pricing level, which is giving us a little bit of a pause of kind of where this is going in general. Now, these are things that we have to watch because maybe it accelerates, but right now we continue to see some of this slowdown, which is accelerating in some of the key growth markets that are going to be the biggest driver for that 2021 growth of 7.6%. Now, when obviously things happen, things get worse, people want more government until they realize that the government is the worst thing that could possibly do to help you. But there has to be a certain amount of social safety nets. The question is always how big, how long should they last? So when you look at, and this is a global backdrop from the Organization for Economic Cooperation, or the OECD, this is where you're seeing more people that want benefits, health support, long-term care, pensions, incapacity, and not surprising, those that had a job loss in the household wanted more support. The question is going to be going forward, how much of that residual stays? Because everybody increased. We saw big increases in support. We saw big increases in just those benefits being given to the individual. When the pendulum ends up swinging, not as much comes off. And we're seeing that with just that steady increase in safety nets with deficits. Government deficits continue to go higher. And people like to quote Keynesian methodology, but in the Keynesian methodology, you stimulate in bad times and take it back in good times. The problem is it's very hard to take it back. Once you start giving someone $1 for 2 years, then you tell them you're taking that dollar away. That's politically political suicide, let's put it that way. And a lot of these politicians want to get reelected, which becomes that problem. Now, when we talk about some of the issues in India, this is what we've been referring to, because obviously India is seeing this massive surge higher, and I have to stop using the word obviously. I apologize, I will. And when we look at what is happening and trying to break out those issues on the COVID side, you can see everything that is bordering India is seeing their own increases from Sri Lanka, Bhutan. Pakistan is just starting to see that acceleration. Bangladesh is flattening out, not so much curling up yet. But this is going to become a bigger problem, because can they maintain a certain amount of distance and allow it to take its course in India without exacerbating the problems that are already in Nepal and the other areas, because they don't have the vaccines available to them to try to counter this and hopefully let it run its course. So then when we look at the vaccine availability, here's where you can see the vaccinations by country. Clearly, the U.S., Europe, parts of Peru have seen the biggest acceleration. Qatar, parts of Middle East. This is going to continue to see that acceleration in general. The problem is how fast. What is the pace of that acceleration? And it remains very slow, which is going to be that problem as we look out to the next few months, because there's a hope that we were going to see this big extensive vaccination push, and it happened at the richer countries, and it's just not being passed through, which again is going to lead to slowdowns, or at least not achieving the growth that was initially projected. And when we think about that hesitancy in the U.S., we talk about it in the EIA show, but those who want to get it can get it right away. It's just those who wanted it got it. And now those that do not want to receive it are accelerating because they didn't want to receive it before. Now that they're seeing COVID cases going down, now that they're seeing other people being vaccinated, it's not the same type of urgency, which is what you're seeing. And that pivot is going to keep this residual in COVID in the system. Now, it won't be at the same level. You're starting to see people that already had COVID, maybe don't think they need it because they already have the antibodies, which is fair. But again, these are those backdrops that we continue to see. But what happens on the other side? So then when we think about the big four central banks purchases, they're supposed to fall from 8.5 trillion in 2020 to 3.4 trillion in 2021 to 0.4 trillion in 2022. The question is, how fast does that happen? Does it get accelerated? The U.S. is humming along. I mean, everything tells me that the U.S. is moving at gangbusters. Everything is exploding. Yay, reopening. But yet the Fed still feels the need to dump $120 billion into the market every single month, on top of the fiscal stimulus that's already coming through. So do they know something we don't? Are they trying to just placate the market? And I think the answer is they're trying to placate the market, because they know that if they accelerated anything, even by a quarter, 6 months, that would have a huge effect in the market where you would start to see the pressure to the downside, which they're trying to avoid. Then when you look at that monetary policy cycle elsewhere, we're starting to see tightening. And this is where we saw it again in Russia. Russia had another surprise increase, starting to see those increases higher. And not only have we seen the flat line, but we're starting to see that edge up. Turkey obviously had their increases, but we're starting to see that accelerate, not only just in Eastern Europe, but also in China, in Asia and Latin America. Now, when you think about what are people willing to do, which of the following would make you comfortable enough to attend a major public event in person? The outdoor space is the biggest one. Mask requirements, proof of vaccination, antibodies upon arrival. This is the biggest component where you continue to see the edge of what people are willing to do. And I think the being in outdoor space is a huge piece, which is why we will see benefits. We will see things get better in the summer because you can have outdoor concerts, you can have outdoor events, you can have a certain amount of comfort being outdoors, assuming that there's a decent amount of people who are vaccinated, a certain amount of comfort. And again, those are things that are going to be a benefit for the summer months. But then how concerned are you about being in public spaces right now? Somewhat concerned still remains the top answer, as people still are concerned. There's still this hesitancy of getting back to normal, which is why, even though there is that vaccination, there is this surge to do more, you're still seeing that, well, I'm going to give it a little bit more time. I'm not in any real hurry. Not a concern at all. Has obviously exploded as we've seen more vaccinations, but the very concern has pretty much gone to nothing, as now it's just somewhat concerned, which has been fairly steady over time, where you've had the very concerned and the not at all concerned flip as we've seen that vaccination acceleration. Now, for how much longer do you expect to have to practice self-isolation and social distancing? More than 6 months is still the most common answer. Now, it dropped when vaccinations accelerated, but now it's flatlined. And when you look at the I'm not sure level and the more than 6 months, if you're unsure, typically the consumer will just be cautious. And the more cautious that they're going to be, that's where you're going to start to see, okay, well, if I'm cautious, well, maybe I'll delay that, or I won't do that, or I'll limit my time there. And I think this really points to some of those perpetual issues that remain in the system. Then when we shift over and we look at the U.S. private equity entries, just speaking where things are focused on just where money's being deployed, and not just the public market, but also the private market, information technology, industrials, and healthcare still are the driving force for what we're seeing. And just based on where so far in 2021, without some significant correction, I think that's really going to continue to be the case. Now, when we look at countries' exposure to foreign investors still remain skittish when we're looking at that investment. So percentage of total government gross debt held by foreigners still remains fairly low when we're looking at 2013 Q1 versus 2020. Overall, we've seen some acceleration, but based on the amount of debt that has come on, you would assume to see a bit more. And we're just seeing that there's still that slowdown or that hesitancy to own some of this debt. And percentage of total debt held by corporations at risk of debt distress, you can see that there's been a big increase where we're looking at the financial crisis versus the most recent quarter, and you're seeing this disconnect where, based on the different countries within Asia, Vietnam, there's more willingness to hold it there. Thailand, Philippines, Malaysia, which I think makes a lot of sense given where some of that growth profile. The ones that we see the most hesitancy going forward is going to be India, because India, again, having that distress level, having some of those issues, and then China as well, as, again, those credit impulses start to come down and you start to see some of those increase in prices. Now, the percentage of developed market capitalization that is a loss-making is at multi-decade highs. We continue to see the growth of zombie companies, loss-making last year, loss-making in each of the last 3 years. You continue to see this recapitalization, and it's looking at a universe of 17,000 stocks as the percentage of developed market capitalization that is loss-making remains at multi-decade high, which just speaks to the amount of problems that remain in the debt market. You've had some things that have gone bankrupt, restructured, but there's still this problem that remains. And if you look at 07 through 09, loss-making last year versus the last 3 years, you had that issue. And you look at the dot-com bubble when we look at the loss-making on the last 3 years, and you can see how long it lasted. But the surge on both, I think, is going to exacerbate some of those issues. Now, how much of this is caused by COVID? That's why we want to look at the last 3 years, because this is just showing you it's not just a COVID issue. This is a perpetual problem that has been in the system that needs to cleanse itself. But as long as central banks continue to be supportive, liquidity in the market, it's going to be difficult to see some of that clearing. Now that we talked about some of the global backdrop, we want to go a bit deeper into wages and underlying inflation as we continue to see it move through the underlying supply chain.